This
Equity Mates
is Equity Mates on tour.
Equity Mates goes to Wall Street.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Now, whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. Now, while we are licensed, we are not aware of your financial circumstances, so any information on this show is for entertainment and education purposes only. Any information is general. And if you have just joined us for the first time, a massive welcome. If you're getting up to speed with the basics, we have a podcast called Get Started Investing that might be worth checking out. But let's crack on. My name is Bryce, and as always, I'm joined by my almost lost his voice, equity buddy, Ren. How are you?
I'm very good, Bryce. How are you?
You're not sounding good.
Welcome to Love Song Dedication.
Hold on, maybe. Yeah, now's the time to get that podcast up and going.
I'm just trying to match your deep voice.
It actually sounds quite good in the headphones.
Well, we could keep it going.
No, we don't want to risk long-term damage. What's happened?
A big US tour.
Yeah.
This is my second day back in the office.
Yeah, so you've just landed. You stuck around in the States for, an extra 2.5 weeks or thereabouts?
Yeah.
What did you do?
Shout out to my sister, Kate, who graduated from Harvard. Went and watched her graduation.
Harvard Law.
Yeah.
Unbelievable.
Saw Tom Hanks speak.
Did you?
And Michelle Yeoh.
Oh, wow.
Yeah, so Michelle Yeoh from Everything Everywhere All at Once.
Yeah.
She was great.
This is as part of the graduation?
Yeah.
Jeez.
So Harvard graduation is like a 3-day affair.
Oh, really?
Not like it was at ANU where it's like a morning, you go get your certificate and then it's see you later. Yeah.
That's 3 days.
3 days, yeah.
Is that just for that cohort, or is it like all subjects? Like, was it just for law?
It builds up. It's like the Masters of Law was day 1, then law school was day 2, then all of Harvard was day 3.
Wow.
Starting at like 6 a.m.
Whoa.
And then you go back to just law school and you get your certificate.
Wow.
So big thing. Tom Hanks, very American.
Really?
Speech.
As in I love America.
These are American values. We got to stand up for the Constitution.
Oh my goodness.
And stand up against fake news because that's not American values.
Really?
Yeah.
Wow.
So everyone who wasn't from America was a bit like, what the?
Wow.
But what do you expect, I guess?
I know. And you were saying that your sister had 2 degrees of separation from billionaire Seth Klarman?
Yeah, so...
1 degree?
So Michael Klarman, Seth Klarman's brother, is a very notable, I think, constitutional law professor, but he's at Harvard, and he was my sister's supervisor for her paper.
Crazy.
And so hopefully we can use that connection to get Seth.
Yes.
For people who aren't familiar, Seth Klarman is one of the best investors of his generation. He's called the... the Oracle of Boston or something, as an homage to Warren Buffett's Oracle of Omaha. So,
yeah, he wrote one of the very first books we read at the start of the Equity Mates journey.
Yeah, I think
Margin of Safety.
Andrew Brown put us onto it.
Yeah.
Definitely the most expensive book we've read because they did one print run of it and then he's refused to print it again. So if you go on Amazon, the secondhand copies sell for thousands of dollars.
Yeah, it's nuts. You can ask us for the PDF link
There
if
are
you'd like.
also other places you might be able to find it, but we don't endorse that.
Now, Ren, so we're back in Oz, but we do have one final interview today from our tour over in the US. And this one does come from New York City, where we had an awesome time speaking to many investors and catching up with some of our shareholders and other people in the finance community. It was an epic time. So our guest today is Joey Brookhart. Now, Joey has gone out on his own and started his own fund very early on I think it's only 6 months since he first launched. So it was a pretty interesting story around what it was like to go out on your own and set up a fund. He's pretty young, and we kind of explore his investment process, and it's a long short fund. So we're interested in how he approaches particularly the short side, and there were some pretty interesting results even as we were recording some of his stocks.
Yeah, Yeah, he made like 40% on one position as we were talking.
Yeah. We're like, dude, you've actually just made a lot of money. He's like, sweet.
But Bryce, as we've been saying throughout this series, this couldn't have happened without Milford. They sponsored our US tour. And so we want to say a massive thank you. And because my voice is going, I'm going to really defer to you for this ad read.
That's it, Ren. A huge shout out to Milford, who are a leading New Zealand fund manager, and they are now available for Australian investors and advisors. Milford's flexible, active management strategies and high-performing, globally experienced investment team aim to deliver strong long-term returns while managing downside risks. Milford's team also invest in the same funds as their clients, so you know that they're highly motivated because they're on the journey with you. So find the Milford funds on your trading platforms or at milfordasset.com.au. And before you invest, be sure to read the fund's product disclosure statement and target market determination found at milfordasset.com.au.
I didn't need to be here at all. Well, without further ado, let's get to this interview with Joey Brookhart from Sandbrook Capital.
Well, Joey, welcome to Equity Mates.
Yeah, thank you for having me.
Now, as is tradition, we'll start with our BizNerdle Equity Mates daily business guessing game. You can play along at home, equitymates.com/BizNerdle. The way it works is 5 clues, up to 5 clues, I should say, with the idea that you get it as soon as you can.
Just before we started recording, you told us that you'd been getting it in one recently.
Yeah, so the Lyft one last week.
Nice.
Under Armour was on there, I believe.
Yeah.
Yep.
Maybe Airbnb as well.
Yes.
I think Chesky was a clue.
So we'll get stuck into it. Clue number 1, I was founded in 2014 by Whitney Wolfe Herd.
Oh boy, I don't know that one.
Okay. Clue 2, in heterosexual matches on my dating app, only female users can make the first contact with matched male users.
Oh boy, I should have gotten Bumble then on the first clue, but I don't, I should follow the dating scene a bit more.
Well, you've got it in 2.
Correct.
Yeah.
Bumble. So yes, for those unaware, Bumble, the ticker BMBL, Whitney Wolfe Herd was previously at Twitter? No,
Tinder.
Tinder.
Yeah.
And then went out and founded Bumble, and now she's a billionaire.
Yeah,
isn't
billionaire.
She? Yeah.
They also launched BFF, a feature for users to find platonic friendships. Without having ever used that feature, I don't think it would have worked.
Who knows? Yeah.
I mean, we're in New York. It would have been prime for us to try and use it while we were here.
True.
To meet some friends.
True.
Haven't even thought about using it.
No. So, Joey, let's just start with a bit about yourself. How did you come to be in Sandbrook Capital and to where you are today?
Yeah, so I started kind of new in high school. I had a job and I was working in an unrelated to finance role for a hedge fund manager there. Really always liked numbers, like narratives and stories, and stock market is just a perfect place for that. Love the fast moving nature. It'd be very tough for me to work at the same company or work in the same job, doing something that's a little more routine. So the idea that something's always going on, you can always have some sort of idea, some sort of thesis out there. I knew I wanted to get into finance, knew I wanted to do that right away after college, which is a pretty untraditional path. Most people go 2 years of banking, 2 years of private equity, some other role, and then transition over to the public equity side. So I had an opportunity right out of college to join a startup hedge fund. I did that for 4 years. Last year, kind of knowing I always wanted to start a hedge fund, I was looking for a job at a bigger established shop, to get some reps under my belt, just using essentially a wider kind of range of resources. So working at a startup fund, you don't have a ton of resources. You have to be pretty scrappy with things. So just wanted some reps using, basically a wider tool set. What ended up happening is, markets have been pretty rough. I cover a lot of technology, a lot of consumer, and just ended up being a pretty opportune time to launch a fund. So my former boss, was kind of the first investor, and just took that opportunity, kind of running with it. So launched that in December. And it's been about 6 months now. What
was like the tipping point, I guess, for you to feel like now's the time? Was it literally just that you felt the market, it was a good time to start a fund, or like it was your age? Like what was the tipping point? I mean, so age is probably a little bit of a headwind, but it was just extremely good time to start a fund in the sectors I cover. So my personal investing philosophy, kind of what I look for, what I really enjoy researching, is software,
a lot of consumer, more growth there, and then internet, and multiples in that sector. Just kind of the divergence, of different trends between. I cover about 50 different software companies. The fundamentals are, there's some huge secular trends, but then there's some maybe a little bit more cyclical than people expect in some of these industries. So it just ended up being a really opportune time to do that. And if you get that opportunity, I knew I couldn't pass it up.
Yeah.
I think a lot of people listening, and I'll include myself in this, like the idea of being able to run a fund is like the dream. Mm-hmm. And we speak to some fund managers who all they do is just quietly learn, be curious, think. It sounds like just a really nice life. I'm really curious as to like how people, like the process of actually starting a fund, like going to institutions or people with deep pockets and convincing them that you're someone that they can trust with your money when you don't have with their money when you don't have a track record and stuff like that. Talk us through the process. Like, take us into the room. Yeah.
So you just start from a legal perspective, kind of knowing first. You first test kind of what you want to put out there. Because at the end of the day, this is a product. You're putting a return stream out there. It's an extremely competitive industry. There's a really good passive option where someone can just buy the S&P 500. There are pension funds and institutions, where it's one guy who sits back and they just own the S&P 500. So you're going to work every day and hoping, on some beta adjusted basis, or depending on the different strategy, you have to go out there and put out a good product in the field. So it came from that perspective. Some people, it's, I'm going to run this fund how I would run my own money. And I have a bit of that. This is a total return focused fund. We're out there trying to beat the S&P 500. I'm running a 10% hurdle, because it's going to skew in, growthier names. But just making sure from that perspective, because right now when you're a startup fund, you're typically not going to someone with, that's going to write you a $20 or $50 million check. Especially at my age, you're going to want to see 3 years of track record. They're going to want to see, what ideas worked, what didn't, what's your thought process, what's your strategy. So from that perspective, in the early days, it's just put your head down and, put a good product out there. So maybe at some point we'll get to, I'll get to a point where, the fundraising becomes, a separate part of it. But at the first few years are just investing.
Yeah, interesting. So let's move on to, I guess, the underlying investment philosophy that you're going to build over the next sort of 3 years. How do you define your investment philosophy?
Yeah, so there's a few things I look at. At the end of the day, every active strategy is a value strategy. People don't call it that, but you're buying something for less than you think it's worth. And I'm looking at something, for my core long positions, I'm looking for something that's kind of in a base case, like a 20% return per year, so IRR, and then some additional optionality on top of that. So I call that kind of the plus portion. So I think about it that way. I'm in a kind of sector coverage as well, so it's a lot of software, internet, and consumer. Because kind of where I think value has gone, it used to be you go look at a balance sheet or an income statement, and this is good value because it's low PE or low price to book. I'm looking in my coverage, what I'm looking for is something where usually, there's something inherent in the business model, the unit economics, the return on invested capital, that the market's wildly kind of misvaluing on some 2 to 5 year horizon. So that's going to be realized by the market. Your job now, just given traditional value analysis can be done by a machine, is figure out what's the thesis, what's this company doing, where the machine or someone else is going to look at it in a few years and realize, the economics of this business are a lot better than expected. So, in consumer and then especially in software is extremely modelable. So you can go in there, it's an extremely metric-driven business. And so you can go in and look at, the cohort or this, customer group, or just an underlying customer, they're doing something on the product side, that's going to increase, the ARR or, the value of this customer on the top line by 20%. They're going to be able to sell this, or, they have a really good customer acquisition engine, and they're going to add on a product here, at that customer acquisition engine, and the returns on a customer are going to go from, a 15% return on invested capital to maybe 30%. So I'll kind of walk you through, an example on Life 360, which is ASX listed, in a second, but that's where a lot of it comes from. And then if you're doing a ton of deep work and a lot of, wide sector work, throughout consumer, internet, and software, it ends up lending yourself to find some interesting opportunities in the short term as well. So a good like active management, especially hedge fund, if you're doing that detailed level analysis, you're going to find some really good shorts. So I really only look at shorter term stuff, which I call an opportunistic long, which is something where the catalyst is in 3 to 12 months. The return bar is a little higher than 20% there annualized, but some big question that the market's looking at is going to be answered, in that, and there's going to be a pretty good, typically re-rate of that company, and your numbers are going to come in pretty, far ahead of street or buy side consensus, which is really what matters. And then shorts are the same thing. I'm looking for something that's really a quarter to 2 quarters away. There's some thesis there where they're going to miss. There's some catalysts where people are going to look at this after the numbers come out and realize, okay, this is lower quality, or there's a different trajectory of the business going forward. And then you're looking at it, there has to, shorting is extremely tough. So you have to have very good risk reward. You have to have a clear catalyst. You have something that's in the numbers. And you can't be short because it's on valuation. You have to have really good risk management process in the shorting. So nothing's over 3% of the book. I don't short stuff that's highly shorted at all. So under 15% kind of short interest. And then there's certain stocks that are just kind of cult, stocks, or really, really passionate, debates on both sides. So, bulls might say this is the next, Amazon, and the bears are like, this thing's, a fraud or something.
It would be great to talk through some examples of each, and also talk through how you construct a portfolio within those 3 different categories. Yeah,
so I'll say when I'm doing my work on everything's kind of done from the perspective of a core long, or the work is the same across. So the biggest thing I think that's really important is the business analysis needs to be completely separate to kind of the return framing. So if you and I are going to go look at a company, we're going to run through the 10Ks, the transcripts, a ton of sell-side research, talk to people within the industry. We're going to do that work, and that's completely separate. So I've kind of, you distill that down to kind of the key debates. How should we think about this? What really matters? There's really only 2 to 3 things that probably drive the returns, both short-term and long-term, for any company. So you're really trying to figure out what those are, and get a view on that. And that's completely, separate. You're just looking, it's not, is this a good business? It's what drives this business, what drives the top line, what drives the cost structure, what's ultimately going to drive, free cash flow margins, and the sustainability, what kind of the quality or, quote unquote, moat around that business is. Then from that perspective, you're going to do kind of the return framing. So my core longs, that's usually like a 5-year kind of IRR out there. So that's in the next 12 months. Here's our operating cases. So might be a bear case. The economy does right now these range of outcomes are pretty wide. So if unemployment skyrockets here in the U.S. or something, or not skyrockets, but consumer starts getting a little tighter with their wallet. What's going to happen to results? What's going to happen in earnings? Revenue. And then what's going to happen, to multiples, obviously. So try to figure out what, moves the stock, and everything's competing because you ideally want something that looks good on that, in your core longs. Because I want a portfolio that's kind of 70% core longs, 30% opportunistic longs, and then 30% catalyst-based shorts.
All right, Bryce, let's take a break there. I need to get a glass of water for this voice. While I'm doing that, why don't you give Milford a shout out?
All right, Ren, we're going to take a quick break, and we must say a massive thank you to Milford, who are sponsoring the US tour and offer offensive and defensive strategies. You can check out Milford's award-winning Milford Australian Absolute Growth Fund. Utilising the skills of Milford's experienced investment team, the Milford Australian Absolute Growth Fund has been focusing on delivering a smoother journey for investors for over half a decade. With an emphasis on managing risk and generating absolute returns, this lower volatility equity fund can play a key role in a diversified portfolio. The fund strives for long-term capital growth while mitigating the ups and downs typically experienced when investing in share markets. So find the Milford Australian Absolute Growth Fund. The ticker symbol is MFOA on your trading platforms or at milfordasset.com.au. And remember, before you invest, be sure to read the fund's product disclosure statement and target market determination found at milfordasset.com.au. All right, we're here with Joey Brookhart from Sandbrook Capital Partners.
Let's go through each. Are you able to provide some stock-specific examples for what's in the portfolio now? what are some of the longs, if the majority are the opportunistic sort of shorter ones, and then also what are you shorting at the moment, if any?
I'll start with a core long, and then something for your Australia-based audience. It's a company called Life 360. So back in 2020 during COVID, Life 360 is an app for families, majority here in the U.S., where they have a free tier and then a paid tier, and it basically helps parents, track a lot of their kids driving, knows where they are. Company went public. It's San Francisco-based, but it went public in the Australia, exchange, because usually, internationally, software companies, tech companies will go public earlier, and sometimes some of these companies can't, access the later stage funding. It was really interesting. Life 360 has a pretty heavy or great freemium funnel. So it's on the top charts if you go into the App Store, the Apple App Store. So they have really, really cheap acquisition of a customer. And they didn't have great uptake of their kind of premium paid tiers. So it might cost them less than $1 to acquire like a family here in the US. But what they were doing at the time was they were coming out with a new product where they bundled in a ton of this other stuff that probably had like $400 of value in it. So it was going to compete against, AAA, which is, towing here in the US. And for $12 a month, there was also going to be phone protection and just some of this other, they found a way to use this really cheap customer acquisition channel and, great installed base of, families here in the US, basically to upsell a product where, it was clear that the returns on these, as customers kind of transitioned over, and then as they kind of paid to acquire new customers at this really low rate, that the value of one of those, a subscriber is probably, 3 times, what it was, prior to that. The company's US-based, and they talked a little bit about listing on the NASDAQ. And in Australia, the company at the time was basically break even. If you go to Australia or any other kind of, even some of the European markets, on the small cap side, people do not like unprofitable companies. Versus in the US, people are happy to pay 25 times sales for, a software company that burns cash and issues a lot of stock to employees and, dilutes their shareholders. It's something where, it's good for a, 10-15% bounce kind of after the quarter, come in right before and exit afterwards. And, that's just from having done work on the name before and being able to find those things every quarter.
So you thought Figs was going to beat, and you went opportunistically long.
Yeah.
Were you right?
Yeah. So the company, it ended up being not as big of a beat as I thought. So I think Strait was at 112 million for revenue and ended up coming in, 120, low 120. They also beat on margins, by quite a bit. Gross margins were about 4% higher than people expected. That flow through on EBITDA was about $16 million EBITDA versus 10.
Well, let's get to your shorts because I'm interested to hear some of the names that you're shorting, the ones that you could share, I guess, or if you don't want to share any current shorts, ones that you have shorted in the past. What are some of the names in that side of the portfolio? Yeah,
I'll walk through. Sonos is pretty interesting. To me, this was, they actually reported last night, done a ton of work on it, was actually long yet, kind of in late 2020, under this kind of framework. It is a hardware company, but the hardware is a little stickier than you would think. So, about a little over 40% of, the products they sell per year go to existing households.
I actually hate Sonos.
Really?
Yeah.
Why do you hate it?
Because you have to use the Sonos app to play. Like if you go to a house,
you can't use Spotify.
You can't plug up. You can use, you have to, it's not as just like a Bluetooth connection, bang, like a JBL or something.
Right.
The connection is not as easy as it should be.
Okay.
It's frustrating. So there you go.
There you go.
Short.
Add that to your short thesis.
Yeah. No, and you can use it from here in the US from like Spotify.
Yeah, but don't you still need the app to connect?
Yeah, I think here in the US you do. So I hold it. It works really well in a, the more you kind of add. So a lot of their big thing during the pandemic, there were a few kind of tailwinds. So obviously people are at home. There was a lot of margin stuff and a lot of some of these stuff that's manufactured in China. Back in 2018, 2019, you're dealing with a lot of margin compression because of tariffs, so Trump's tariffs. So they were dealing with that still in 2019. But then you also had obviously all the supply chain stuff, so getting components. So they were always, just hugely, hugely backward. It might be every product's like a 6-week wait online. People are trapped at home. they're doing work on their home, so they're going to come in. Sonos is partly sold through like Best Buy, which is an electronics retailer here in the U.S., and then through an installer channel, so professional that comes in and actually will use one of their kind of product that basically makes everything available to you on your phone to control different groups. Even if you're not like using a Sonos speaker on that, you can plug in stuff that's built into your home. So the thesis was, people are actually undervaluing just that customer relationship there at Sonos. They have a decent product engine. You have some good tailwinds, obviously during COVID, you have people being at home. And then two, the average selling price, what they're selling during COVID was a lot of like home theater stuff. And then this installer channel, which are like, $700, $800 products for them versus, some of their other, stuff. And this is kind of to the short thesis, it's a little bit transitioned over as they try to basically broaden out the offering to, they've been introducing some lower price products. So that's kind of a headwind to the mix. You had last year, they were basically refilling, because you couldn't get this stuff during COVID. They were refilling a lot of like, Best Buy's, inventory of it, or the installer channel. So if you looked at Sonos and kind of modeled it on where kind of the units were, because they break this out, like what's our difference between speakers, these system products, which are the installer stuff that would control, everything on the Wi-Fi, and through your app, just control all your different speaker zones. And then they have some, other revenue that's like IKEA. If you did kind of the modeling work and kind of backed out what, they give a unit number, just total company-wide, what they sell, you can kind of guess, because the prices on the system side don't change at all. The mix there is basically, a $700 product that's sold out there. You could go model the units back, and it was, just extremely, extremely clear that it was going to normalize. And these COVID normalization stories aren't new, but they show up in different sectors at different times, essentially. So right now, I was waiting. Q1, I was like, Q2, the street was at 380 for revenue. It's like, this is going to look like a little more. It's going to look like normal seasonality. If you look back at 2018, 2019, given the compression they have, is they launched the Roam, which is they launched this Move, or not Move speaker, but the Beam, which is kind of the lower priced sound bar. It's just clear that there's going to be just a massive miss here. And the stock actually didn't react negatively. They basically guided to $305 million in revenue in Q2 versus, street at 380 back when they, announced their Q1 results. And they beat Q1 pretty sizably, but they kept the full year guide the same. And then finally last night, they took down the full year guide, quite sizably by, 8%-ish.
I've just looked up how they opened today as we record, and they're down 23%.
Yeah, I mean, it's...
So you've made some money today.
Yeah, and the thing too is when you get on the catalyst side, you want to be very different on the number, on the short side, and then on the opportunity. If you're doing something short term, you need a catalyst. You can't short off valuation. But then when you get a number right on one side or the other, there is a momentum factor and a kind of a narrative factor that enters. So like a big thing was, with Sonos, it's going to go back to kind of the pre-COVID thesis that this is, a hardware manufacturer. They compete exclusively with big tech. So as the numbers actually trend in one way, that's where the narrative goes as well. Which makes for some great stuff. Like if you look at Meta, right? When you get the IDFA side with Apple, that's hurting ad revenue. You get the TikTok competition. Is there any terminal value, in this company? And then they go out and you look at like the Reels data versus the TikTok app data, and then they come out with on the ad side. You have conversions API. And some, tailwinds, you have maybe a little bit of flight to quality with an ad spend. If you can catch those things in the catalyst, side, and then the narrative is working for you too, these moves can be very, very powerful.
Well, Joey, we are running out of time. So you mentioned at the top that, as a smaller fund, you have to be a little bit scrappy when it comes to the resources that you use, particularly against the bigger funds that are out there. So for those budding fund managers at home, and for Ren and I, what are some of the key resources that you use in your investment process that we could go back and use in ours?
Yeah, so unfortunately there's some stuff I do invest, personally fund a lot of research budgets to get somewhat competitive with a lot of larger funds. From the data perspective, the biggest thing, Twitter is a huge help. There's a lot of, you'd be shocked at some of the people, on Twitter, if you search up a ticker. If you knew kind of who is behind that account, you'd be pretty shocked. We've mentioned on Reddit security analysis before. It's a great place to read letters. If you're US based, and you get like a brokerage account for, a lot of these things are no minimums. You can get, JP Morgan research, Morgan Stanley research, Bank of America research, for nothing. And, there's a lot of these sell-side reports have, they might consolidate some data source or something and do some edge there. But the biggest thing though is you can find everything you need, the company documents, so the 10Ks, investor presentations, the transcripts. That's 90% of what gets done on a name, or the info you need. Maybe 80% gets done just from reading those documents. Going back, putting the story together, figuring out what drives that company. What matters for it, what matters for that industry. And then going into, I know there's some really cheap stuff that helps with downloading data to Excel. So I think something called Y Sheets. I use a professional. I pay a bit of money for my version of that, but you can find these resources easy if you just go search. So, but biggest thing is you can get 80% of the way there just reading the filings and doing digging in like that. And trying to figure out that way.
Nice. Twitter is one that is often mentioned. So if you're not on it, you can get on there. The cash tags is what. Is it cash tag that you use?
With the dollar sign.
Yeah, with the dollar sign, and then you search the ticker.
Yeah.
And it'll bring up all the conversations around the stock. Now, Joey, before we do go, there's one final question. Each year, the Equity Mates community vote on their favourite investor, as expert investor, as part of the Equity Mates Awards. It's an opportunity for our community to vote for an expert that they feel has really contributed to their investing journey. And by the nature of coming on the show, you are automatically in the running to win it.
Oh, wow.
To help them with their decision at the end of the year. If you were to win and we send across the beautiful glass trophy, where would you put it?
Well, it'd go in my office. My office is probably 8 by 10 feet. There's no window in there. So it would just sit, there's a bookshelf that a printer sits on top of, and
Nice.
it would go right there. So that's about all the room. I'm not even, my office is so small, I'm not sure it'd fit.
Fair call. Well, Joey, thank you so much for taking the time to speak with us today here in the States. We'll include a link to the letters and in the show notes. If anyone wants to keep up with what you're doing, is there a best place for them to do so?
Yeah, I don't use my Twitter account that much, but there's, the letters do end up out there on Reddit or my Twitter, and then my email's at the bottom of every letter if someone wants to talk a stock or.
Nice. All right, well, we'll include those details in the show notes as well. But Joey, thank you so much. It's been an absolute pleasure.
Yeah, thank you.
Thanks, Joey.
Well, Ren, that brings us to the end of our US tour. It was an epic experience.
Yeah.
We'll be back on Thursday with a mentored episode and a bit of a recap on what's been going on in markets, because there has been plenty happening. But it was just a great experience to sort of go over and see Warren and Charlie and experience the Berkshire AGM, and then head across to New York and get the opportunity to speak to some investors over there. So we'll wrap it there. But again, a huge thank you to Milford, who have been able to give us the opportunity to get over to America and do some awesome content. They are a leading New Zealand fund manager, now available for Australian investors and advisors. Milford's talented and globally experienced investment team aim to deliver strong long-term returns while managing downside risks. They also invest in the same funds as their clients. So you can strive for a smoother investing journey with Milford's experienced active management and their award-winning Milford Australian Absolute Growth Fund. The ticker symbol is MFOA. So find the Milford Australian Absolute Growth Fund and other Milford funds on your trading platforms or at milfordasset.com.au. And before you invest, be sure to read the fund's product disclosure statement and target market determination found at milfordasset.com.au. A massive thank you to them. It was an epic trip. Hopefully the two, Warren and Charlie, last through to next year and we might be able to get it back up again. But Ren, we'll pick it up back here in Oz with a market wrap and mentored next week.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.